All right, so in this video, I wanted to look at earnings during market crashes. So I'm just going to look at the exact period that the market last crashed, not necessarily March, but not March 2020, but let's say 2008, a longer period. So what is this? This is 2017. I'm going to have to click on max here. Actually, let's look at the big chart instead. So 5 years. We're going to go back to 2008. Alright, so you could see a crash around here. So between August 2008 to to March 2009. So August 2008 to March 2009. So that's about 4 plus 3, about 7 months of crashing. Okay, so let's look at that period. Is there anything else before? No. So the whole 2008 crash was really, well, it started around here actually. Started in October 2007, all the way down to March 2009, and then we recovered quite quickly. All right. So let's look at what happened to stocks when they announced earnings during that period. So I'm going to go to a website called Earning Stats. And I'm just going to look at some random stocks here. I'm not going to look at all of them, of course. So let's look at Apple. And I'm going to look at actual versus expected. So I'm going to compare the actual movement versus the expected movement. I'm going to try to look at periods between, I guess, 2008, all of 2008, and the first few months of 2009. So hopefully we have these values here. So yeah, you can see October, this is what, 2000, this is October 16. This is, if I click on it, does it tell me anything? So this is October 11, 2005. Nope, I want 2008. This is 2007. Nope. So this is January 2008. So this is, I guess, definitely included in the crash. So the expected move was about 10%, but it actually dropped 12%. So in this case, in this scenario, the stock dropped more than the expected move. So that's not good for selling. In the case of the strategy that I'm paper testing, is selling an out of the money put at expected move for earnings. October 2007, which was the beginning of the crash, you could see that the stock actually went up. The expected move was 7%. The stock actually went above that. It moved up 8%, but it didn't drop, and it was at the beginning of the crash exactly. So the next one here, we just said drop below, so that's not good. The one after, which was April 2008, so still in the middle of the crash, the stock actually went up. The actual move was only 1%. The expected move was 8%. And then the one after that, it was expected move was 7%, and the stock actually dropped 10% after. So that's not good either. And then after that, we've got October 2008. We have actual move 6%, while the expected move was 12%. So that would have been good. So if we look at these ones here, maybe go for another one in 2009, January 2009, and then April we started to recover. So let's stop at January 2009. You can see the stock went up, and it did not go above expected move, but it went up. So an out of the money naked put at expected move during a crash, we could say we were looking at October 2007 would be the first one to look at. So this one would have been a winner. So out of 1, 2, 3, 4, 5, 6 occasions, we would have had 2 losers right over here. So 2 out of 6 occasions would have been losers, and that's in a market crash. So that's Apple. Let's look at another stock here. Let's look at Adobe. Adobe has earnings this week actually. Thursday after hours. All right. So do we have? Yeah, we have 2008, 2009, or 2007 to 2009. So this one here is March 2007. I think I want after October 2007, right? So December 2007 would have been a winner. March 2008 would have been a winner. An out of the money naked put at expected move would have been a winner. June 2008 looks like it would have been a winner as well. Expected move was 5%, but actual move of the stock was only 2%. So it could have been a winner. That's assuming it doesn't drop even more after the stock, the days after. But June 16, 2008, if that's a Thursday, then a naked put, an out of the money naked put at expected move would have been a winner on that day. And then September 2008, another winner, and then December 2008, another winner. March 2009 is when we stopped the crash and the market started going back up again, would have been a winner as well. So in the case of Adobe, out of 6 or 7 occasions, they were all winners. In the case of Apple, out of 6 occasions, 2 of them were losers. Let's look at another stock. Let's look at Amazon. Do we have 2008? Yeah, okay. So, Amazon doesn't look too good. All right, so October 2007, Amazon dropped 9% or 10%. Expected move was 11. So, I'm not sure if the out of the money naked put would have been a winner, but it's pretty close. Maybe a scratch, and it all depends if it came back up afterwards or if it continues to drop. So, I'm not sure about this one, but it was close. The next occasion here was January 2008. Expected move was 11%. Actual move was a drop of 7%. So pretty close as well. We're not sure exactly, but probably could have been a small profit. The one after April 2008, this one looks like it would have been a winner. I think also Amazon usually has earnings at the end of the week. Let's look. April 23rd, 2008. Let's see if it was a Thursday or Friday. I think Excel has that function, right? Let's put it in Excel here. April 23rd, 2008. How do I find out if this is I think it's weekday. Weekday is the function. Weekday returns, what does it say? Returns a number from 1 to 7, identifying the day of the week of a date. Okay, sure. So serial number, I don't know. What's a serial number? Oh, I'm going to choose this. Return type will be, okay, numbers 1 through 7 is 1 being a Sunday, and then, or 1 to 7, 1 being a Monday. So let's choose number 2. So it's a 3. So if 1's a Monday, so 3 is a Wednesday. Okay, so in this case, it was a Wednesday. So we would have had about 2 days to go, 2 full days to go before expiry. So a lot could happen in 2 days. So still can't tell if it would have been a winner, but it was close. And then July 2008, this one's definitely a winner. An out of the money naked put is definitely a winner because the stock went up even during a crash. July 2008 is around here. So look at this, yeah. It's right before the big drop, but it was still part of the crash. It's around here, yeah. The biggest drop was between September 2008 and October 2008. So that was the biggest drop. What else do we have here? But sometimes earnings is not exactly during the crash, right? So where am I? I think I was over here. July 2008. Next, we've got October 2008. Yeah, that's pretty bad. Look at this one. It does not cross expected move, but it definitely came pretty close. So can't tell if it's a winner as well. January 2009 is definitely a winner. And then after that, we have April, which is after. So for Amazon, it's pretty close. I think it's overall might be a scratch, maybe even. Well, we do have a few winners in Amazon, but most of them are pretty close. So hard to tell for Amazon if an out of the money naked put would have worked during a crash. Let's look at American Express. It's not that volatile. So 2008 is, or 2007, October 2007 is good. Whereas October 2007 is over here. So it went up, so that's good, winner. This one, it dropped after earnings, but inside of expected move, so that's good. The next one here, April 2008, is a winner as well because it went up. The next one here is a loser because it dropped and it went past expected move. So this one's definitely a loser. The next one is a winner, October 2008. So this is during the heart of the crash. Expected move was 14%. So look how high expected move is. That's really high, and that's most likely because because volatility was high. The expected move was 14%. The stock only moved 3%, 3.8%, and it moved up on top of that. So an out of the money naked put would have worked. January 2009, expected move was 11%. Stock moved 6%, but towards the upside. So an out of the money naked put would have worked. And next here, I think we've gone too far. Yeah, April. All right, so I think out of 6 occasions or 7 occasions, 1 is a loser for American Express. Now, does that loser make up for all the profits? Well, it depends on how much premium you collected from the winners, and also depends on how much you lost on the loser as well. I'm going to skip Baba here. Let's go to something more popular. I guess CMG. Does it have 2008? Yeah, I think it does. Yeah, okay. So October 2007 would have been a winner. February 2008 looks like a loser. April 2008 is definitely a winner because it dropped a little bit. Expected move was 10%, but it only dropped 2%. July 2008 is a loser as well. Might be a small loser. October 2008 is definitely a winner. Expected move was 15%. It only went up. The stock went up 3%. And then February 2009 would have been a winner as well. So as you can see, in this case, an out of the money naked put at expected move would have been a winner for this overall for this stock during a crash. What else do we have? Let's definitely do Costco. All right, Costco 2007, September 2007, it flew. Forget that one. December 2007, it actually dropped outside of expected move. That's a little weird, but yeah. It doesn't have high expected move, maybe that's why. So expected move was 4.7%, the stock dropped 6.7%. So an out of the money naked put would have been a loser there. March 2008 would have been a winner because it only dropped 1%, while the expected move was 4%. And then next earnings was May 2008. That's a winner because the stock went up. And then the next one here is September 2008. Stock dropped a lot, but it did not drop more than the expected move. But I don't know what the price of the premium would have been at the open, so I'm not sure if it's a winner or not, but might be safe. Next one here is December 2008. Expected move was 5.5%. The stock dropped 2.7%, and it looks like a winner because it didn't drop more than half of the expected move. So it looks like premium-wise, looks like it would have been a winner. And then finally, March 2009 is definitely a winner. So Costco, you've got 1 or 2 maybe losses on Costco out of 6 occasions. 6 or 7 occasions. And then what else do we have here? CRM, no. Disney, no. I guess we could do Disney or EA or Facebook. I guess let's do Facebook because it's very volatile. Okay, Facebook wasn't public, I guess, in 2008, or didn't have, or the site doesn't have stats about it. Let's go to Disney. Disney, we've got, where's 2007? This is May 2008. Let's look at the first one here. What does this look like? This is August 2007, no. So November 2007 was part of the crash, or when the crash generally started. This one looks like a winner. Expected move is 4.4%. Actual move is 2.4% to the downside. And then the next 2 earnings were winners because they went up. And then after that, July 2008 looks like a winner as well, but comes close. November 2008 looks like a winner as well. Expected move is 11.6%. Stock dropped 5%. So that's why I feel like it's not necessarily gambling, because you're still giving yourself a lot of room to be wrong. I mean, 11% expected move. The stock can fly. So you've got all this to the upside. The trade can be a winner if the stock goes up, anywhere up. If it's flat, or if it drops, it can drop, up to 5 to 10%, and it's still a winner. If it drops more than 11%, then it's a loser, and you don't know how much you'll lose because it's a naked position, especially if the idea is not rolling, but just to close the trade as is. You don't know how much you can lose yet. But based on this, it looks like it would have been a winner. And then February 2009 as well looks like a winner as well. Okay. Next here we've got Domino's Pizza. I guess let's do Domino's Pizza. So 2007, October 2007, it dropped. Expected move was, this one's close. I can't tell if it's a winner. The next one here is February 2008. Looks like it would have been a winner. April 2008 looks like a winner as well. And then we've got, after that, July 2008 is definitely a winner. October 2008 is a winner as well. Expected move was 10%, stock dropped 4%. Then finally, February 2009 is definitely a winner. Expected move was 15%. That's very volatile. 15%, and the stock went up actually just 2.8%. So a short straddle would have been amazing there with that 15% expected move. But I'm just testing an out of the money naked put instead. Let's look at FedEx. So FedEx here, 2007. Not September, but let's do December. December 2007, expected move is 3%. Stock only moved 0.5% to the upside. So a naked out of the money put would have been a winner there. Next, we've got March 2008. Looks like it's close. Expected move was 3.7%. The stock dropped 2.6%. I'm not sure if it's a winner, but it's pretty close. The next one I would say is a loser because actual move was 4.2%, while the expected move was only 3%. So it dropped more than the expected move, so definitely naked put would have been a loser there. And then September 2008 is a winner, the stock went up. December 2008 is a winner, the stock went up. March 2009 is a winner, the stock went up. So 1 out of 6 occasions would have been a loser for FedEx during a market crash. You don't have to care what the market is doing. You enter the trade before the market close. And then you close it the next day. So you're in the trade just overnight, and you basically make almost full profit depending on what happens, of course. Sometimes it's a loser, but the idea is hopefully most of the time it's a winner, and the winners compensate for that one crazy time where it's a loser. And that's what I'm still testing out. I'm not even sure if it's sustainable, but the idea of selling volatility makes a lot of sense to me. And there's nothing, I mean, earnings has the most volatility, and I don't like to do strangles because it adds a restriction. Basically, I'm expecting the stock to stay within a smaller range. It has to stay within the upside and within the downside. And if I have to pick a side, I don't know. I have no idea where the stock's going, so I don't want to pick direction. So instead of picking a direction each time, I'll just stick to one side every time and hope that this side wins more often. And it does look like it wins more often. I mean, just looking at the chart here, you can right off the bat, you can see there are more green bars than there are red bars. So right away, you can see that what stock are we looking at here? Google. You can see that it goes up more often than it drops. And even when it goes up, it surpasses expected move by a lot. When it drops, sometimes it does surpass expected move, but it doesn't drop as much as it goes up after earnings. So Google, let's look at 2007. So we've got January 2008, I've got October 2007, perfect. This would have been a winner. January 2008, expected move was about 10%, stock dropped 6%. So kind of close, who knows? Can't tell if it was a winner, but it probably would have been a small winner, or at least a scratch. And then April 2008 is definitely a winner. A naked out of the money put is definitely a winner. And then July 2008 looks very close, probably a scratch. October 2008 is definitely a winner. So this is like the heart of the crash here, and you would have made full profit on a naked out of the money put on Google, in and out overnight. January 2009, another winner as well. So yeah, you can see, you can make your own conclusions here. Let's look at Home Depot. Home Depot. Am I at Home Depot? Okay, Home Depot 2000. Oh, that doesn't look good. February 2008 looks like it's definitely a loser. We've got something here, but it's so small it doesn't show. But it looks like it's a winner over here. There's like I think there's an event here that's missing. Looks like it was completely flat. But yeah, so we've got because if I look here, August, and then we jump to February. So there's definitely an earning event here, but it looks like it was completely flat. That's why you don't see any bars. So anyways, this one would have been a winner. This one's a loser. This one looks like it could have been not a full winner, but a profitable trade. August 2008 would have been a winner because it's flat. November 2008 is a winner because it went up. February 2009 is a winner because it went up. So even during market crashes, earning trades are winning. Let me just zoom back out here. Okay, next stock here. Here, let's zoom out again. All right, next stock. Should we do IBM? It's not that volatile. Johnson & Johnson. Oh, let's do Lululemon. If it was, no, it wasn't there before 2010. Let's do MasterCard. Yeah, MasterCard 2000 May. No, what is this? August 2007. Okay, October 2007 winner. January 2008 winner. April 2008 winner. July 2008 pretty close, maybe a scratch. November 2008 winner. February 2009 winner. So I don't know. This looks good to me. Next, let's do. Oh, I don't want to see. I saw Netflix on the list. I don't want to do Netflix. All right. So Microsoft. Do we have 2008? Yeah, we do. Okay. So January 2008 winner. April 2008 pretty close. Can't tell if it's a winner or just a scratch. July 2008 same thing. Pretty close. October 2008 expected move 9.6%, actual move 5.6% to the downside, so pretty close, maybe a small profit. January 2009 looks like a scratch, maybe a small loss, and then April 2009, well, this was after the crash, but it's a winner. Let's jump to Netflix, or let's do McDonald's before Netflix. Hopefully McDonald's give us good numbers. Ouch, look at this. McDonald's January 2008 was a loser for sure, but a small one. October 2007 is a winner, okay, because it didn't drop past expected move. April 2008 is a winner because it didn't drop past expected move. July 2008 is a winner because it went up. October 2008 winner because it went up, actually barely went up. January 2009 is a winner because it dropped a little bit, not more than expected move, so that's good. Alright, let's go to the famous Netflix. This is the one that could probably ruin all the numbers. Okay, so it wasn't even available during a crash. Perfect. Let's look at Nike. 2000, well, the big red one here is going to be a 2008, so this one's a loser. June 2008. March 2008 is a winner. December 2007 is a winner. September 2008 is a winner. What is this small one here? December 2008 is a winner as well. March 2009 is close. So we've got only one loser out of 6 or 7 events here. I like ServiceNow actually. ServiceNow does pretty well. Yeah, I like ServiceNow. Let's look at Nvidia. I know Nvidia had a really bad drop eventually. It was in 2004. Okay, good. Alright, so, and another one in 2018. Okay, so in 2007, where do I find 2007? Probably here. May, no. August, no. I want October 2007. So November 2007 would have been a winner. No, February 2008, a winner as well, because it didn't drop more than expected move. What's this small one here? But it's definitely a winner. May 2008 is a winner. So when I say winner, I'm talking about an out of the money naked put at expected move. And how do I get expected move? I just look at the straddle value. At the money straddle value gives me an approximate of the expected move. Alright, this one here is August 2008 is a winner because the stock went up. November 2008 is a winner because stock went up. February 2009 stock dropped, but not more than the expected move, so probably would have been a small winner as well. So I'm going through these ones, and honestly, the more I'm going through them, the more I'm liking these earnings trades, even during a period of crash and uncertainty. Because as you can see here, the crash here was between 2007 and 2009, and I'm looking at earnings during this period, and you can see here for yourself, they're mostly winners. Let's look at PayPal. Not available. Qualcomm, Roku, Starbucks, Shopify. I don't think Shopify was around. Nope, it's brand new. Square, Target, Tesla, I think is brand new as well. Yeah, definitely brand new. Ulta Beauty, I'm not sure. Oh, I didn't know it was that old actually. Let's see if we can get anything. So yeah, we actually can get something on Ulta Beauty. So 2007 looks like a small winner. March 2008, a winner as well. June 2008, definitely a winner because it went up. This September 2008, a winner as well because it went up. December 2008, wow, expected move was 25%. You can't ignore that. Expected move was 25%. Actual move was 10% down. So definitely the naked out of the money put would have been a winner there. March 2009, expected move was 27%. A straddle would have paid so much. 27% expected move, and it only moved 1.6%. That's amazing. March 2009. Yeah, so definitely looks good for Ulta Beauty here during a market crash. Let's do UPS, Visa, and Walmart. Although Walmart doesn't have high expected move, doesn't have high volatility, but let's look at it. So UPS, 2000 and we're 7. October 2007, winner. January 2008, looks like a winner. April 2008, winner. July 2008, winner. What is this one here? October 2008, definitely a winner. February 2009, a winner as well. So I don't know. I'm liking earnings during crashes. It looks really good to me. So what else do we have here? Visa should be similar to MasterCard. So Visa, April 2008, looks like a winner. Expected move was 9%, it only dropped 2%. And then next year, expected move was 7%, it only dropped 3%. Looks like a winner. October 2008, definitely a winner. Expected move was 12%, it barely moved. February 2009, expected move was 7%, the stock jumped 6%. Definitely a winner. Looking good for Visa. And finally, Walmart. Walmart doesn't look too good. Alright, August, no, I don't care about August. So November 2007, winner. February 2008, winner. May 2008, pretty close. Maybe a scratch or a small profit. August 2008, winner. November 2008, winner. February 2009, winner. I don't know. I'm liking these odds. Alright, just wanted to share with you what, according to this website, what stocks have done after earnings during a period of market crashes or uncertainty. So if you have any questions, if you enjoyed this video, leave it in the comments section below. Like always, check out the referral links below. You can get $50 if you open an account with Questrade. Thanks for watching.